All right. Good morning, everybody. Rob Barnes with Integrated Insurance Consulting. We appreciate you taking time out of your day to learn with us. Today's topic, long-term care, what advisors need to know. This is a newly revised presentation, so I have a lot of material and I'll be talking fast, but you'll get a replay and I'm going to start going. So we're going to continue to provide resources to you so you can have better client conversations about long-term care. It's very clear that in the insurance business, we're on the protection side of protection versus probabilities, but what side are you on? And even better, what side are your clients on? A simple reality in life is you're either going to live, die, or become disabled. And there's a lot of risks we face in retirement. And I'm going to suggest that we need to stop facing these risks one at a time and look at them together. And we'll talk more on that in the program. There are an array of products available to insure for long-term care these days, and we're going to provide the insight to how they work and where they fit best. And in addition to helping educate you, we continue to help you educate your clients. So we'll share with you our client education portal so you can share that with your clients and leverage your time a little bit. And so sometimes the mainstream long-term care products won't work or are not available due to health of your clients. And so we're going to share some alternative strategies for consideration when we think outside the box. So we all are working under the most popular statistic for long-term care, and that is that once you reach age 65, you have a 70% shot of needing some kind of care during the rest of your life. But we can break that down a little bit more, that we know that about half of the people are going to either not have any claim or need care less than a year. And of course, it's the other half of the coin that we're concerned with, especially when you start getting into those 2 to 5 years, or even worse, the 5 years and beyond. The words dementia and Alzheimer strike fear in all of us. The reality is some of the statistics are scary on their own. We don't have to scare clients any extra. As we age, our bodies, or even worse, our minds start to fail us. And at some point, the health deteriorates where we need some help. And we want you to have a plan, and we hope that they have family discussions as well. It is a very emotional subject. It's best to discuss the plan of what if while you are of cognizant, sound mind with your family and your loved ones. And most importantly for you as an advisor, documenting and discussing these topics are of vital importance. And you want to consider insurance to leverage and protect assets, but having a plan doesn't mean you're buying insurance. But insurance could or should be analyzed along the way. So these stats up here are just, we're seeing more and more Alzheimer's claims as the baby boomers further progress into the retirement stage. We're looking at the marketplace to double in the next 30 years, and that's a scary thing. On the board are statistics that are actual claims and statistics made from the claims that we're aware of. One of our long-term care carriers went around to other carriers looking at what their longest claims are. You see, we used to have lifetime benefits from a lot of different companies, and now, as far as I know, there's a couple companies in the industry left that allow lifetime claims. But the average claim for men is 2.2 years, and the average claim for women is 3.7 years. And of course, we all fear the claim stats that you see there. The orange are for females and the blue for males, and there's some claims that are in excess of $2 million. So the devastation is real, albeit not a large portion of people are going to have a dementia claim like this. So when we look at costs for care today and tomorrow, even home care can be costly. Today, just 4 hours a day of home care can cost about 40 grand. And if we look at this happening 20 years from now, It's 130 grand for just 1 year, and it's up to 660 for 5 years of needing care. So that can put a dent in the cash flow and the pile of money for clients. And even worse, when you look at somebody needing 5 years of nursing care 20 years from now, that could be over $1 million that they have to pony up. Now, I could show you statistics all day, and there's a lot of them around. And I'm a music fan. I get a lot of, I like to read lyrics and study what the message is, if it's not apparent at times. Anyway, Todd Snyder is one singer-songwriter I'll turn you on to today. Statistician Blues is the name of this song. And in it, he sings that 65% of statistics are made up on the spot and 82.4% believe them, whether they're accurate statistics or not. But it's the refrain that he sings about too much to think about, too much to figure out, stuck between hope and doubt. And I think this captures the long-term care exposure that we all have concern with. And so we need you to figure out what you believe, and we need you to have conversations with your clients to find out, are they on the probability or protection side of things? Again, in the insurance business, I put safety nets under people is what I look at that I do, whether they live, die, or become disabled. And so the plan just needs to be figured out, and there's two important questions. Who's going to care for you, and how will you pay? And we have family, government, self-insure, or insurance to look at as far as options. But the reality for many is that they think family. And I'm going to share some of my dad's story along the way, because he was one of these Alzheimer's claims. And in my mom and dad's situation, we didn't have a lot of options, so family was vital, and we cared for him for quite a while before he actually became a statistic needing care elsewhere. But I often hear from people, this is more the female than the male, that, hey, we're all set. We have a plan, and the family plan is the kids. And then my question to them is, have you told them? Because that's the next logical question here, and often they have not. And so that might be a smokescreen objection, just to not have this ugly conversation about being decrepit someday. But it's important to get past that. And you're the advisor that needs to help them do that most of the time. And for your younger clients, I like to ask them if they know about their parents' long-term care plan. And if they say no, then I ask, how do you know that you're not the plan? That's the opposite end of this. Now, that might be a way for you to get a new client, but it's also a way for you to help your younger clients protect themselves from having to rely on. I know that some well-to-do clients help buy long-term care on their parents, so they don't have to be the caregivers, and they can hire quality care for them. But there's a lot of consequences going on here: the physicality, the financials, the emotional, and then how will it impact the kids caring for the parents? Are they even living close to them where they can? Are they healthy enough to do it? What about their financial resources? If you're spending less time at work because you're going by and caring for mom and dad every day, that might impact your retirement plans and be something concerning in the long run. So with limited means and no insurance, family or friends or the government tend to be the only options available. And what we know, and what we continue to see more of, is we know that most caregiving is free. Now, free doesn't come without a cost. In the last, my dad passed last year, and he had the dementia for more than 7 years. And it's a long, drawn out drama, and there was heartache and pain along the way. And it is an indignant situation to see people go through. But as part of our kit, we will include a caregiving resource guide, which you can share with your clients when needed. And we know this, for the people who do have insurance, it's a lot easier to get that care. And so they do. And they often get the care sooner than they would have had they had no other options. And clients, more so than us advisors, or they think that the government will pay for their care. We know better. We know that it only pays a limited amount of days after you've had a stay in the hospital through Medicare. From there, it's Medicaid that pays. And if you've ever seen a Medicaid facility, they're not the highest quality places to be in. So diminished care might be the course if you're on that course. And to the right-hand side, we show that if you're a married couple, they're only going to let the spouse keep 109 grand, their house and their car. Everything else will be turned over if you're running out of money. And in the right-hand corner there, you see the words filial law. I don't want to be discussing too much on this, but filial law means essentially if my parents were to spend down their estate and have the government pay for their care, they could come back and get the money from me or other children there. And these filial laws are on the books in about 30 states. There's been a few that's been actually starting the course of going to collect. And there's a lot of strain on government right now with all the spending, and Medicaid is one of those strains. Long-term care is a societal problem, and therefore I'm suspect that filial laws will be utilized more and more to help reimburse when appropriate. So keep that in mind as far as discussing things. And so if we're not using family, if we're not relying on the government, that means we rely on our pile of money or we insure for the risks at hand. And so if we're going to use our money, of course, we don't know if we'll have enough with certain asset sizes. And if we do need care, what account are we going to draw from? Are we going to borrow from the house and do a reverse mortgage? Are we going to pull money out of our IRA and have to pay tax on the way out and have that shrinkage? Or are we going to use our stock and bond portfolio, perhaps in our IRA, that not only pays a tax, but shrinks because the market's down this year and we can't wait for a rebound, we need the money. And so these are all considerations. And when you have a bad sequence of returns in order, you can see a pile of money dwindle pretty quickly in situations like that. And so for many, they want to transfer the risk. It's what we do with other large purchases, right? Our autos and our homes. It's too big of a deal if my home blows up and I want it replaced. I can't take that risk. And so it might be the same way. And so the transferring the risk, we take a little bit of our money and leverage it into a bigger pile. We create tax-free benefits, and that allows us to get the quality care that we need when we need it. And so leverage your money into tax-free dollars through traditional long-term care, hybrids, and life or annuities with riders. We're going to look at all those in a couple of minutes. And so life from my perspective is pretty easy. Everybody I meet is either going to live, die, or become disabled. And we have insurances for all of those. If you live, you aspire to have a pile of money or a stream of income to live off of. And this is where annuities come into place. And I know that some clients, the ROI factor that they care about is the reliability of their income. And if you die, where are you leaving the rest of your family, right? And I don't know if you follow the advisor perspectives articles that are out there. There was one going around recently talking about the widowhood penalty. And essentially this is, husband gets sick, they don't have any care for him, they spend down some of the pile of money, husband dies, and then the wife loses Social Security income in the household. She might lose some pension income depending on if there was and what options they've taken. But they just recognize that the widow is left with less. And I just quoted on a comment in it is, it'd be a nice thing if they had some permanent life insurance on the husband, right? So that it helps replenish the bucket and offset those things. Well, today, we can buy life insurance policies with a long-term care rider as well. So we could have even used that if they had it, but we can avoid the widowhood penalty in many situations, and insurance as the safety net might be one of the ways. So long-term care is not guaranteed, but death is. And that's what makes the conversation of life with rider a little bit different. If I had that, I personally own life with rider myself. And it can be used in a myriad of ways. What I don't use for care will be left to my family. And having that policy allows me to a permission slip to annuitize other assets later if I want to, or leave a legacy as well if I don't need much care. And so you're on the call today because extended care is an issue and a concern with many of your clients. And what I want you to know is you can protect your younger clients too. I don't spend a lot of time talking to younger people about being decrepit someday, but I like to protect their income with disability insurance. And what I know is if they're in a car crash and they're disabled from the waist down, that's one scenario. But if they're disabled from the neck down, that's a whole nother scenario. The disability is there to replace their paycheck. Now what pays for their care? And so you can do things for younger clients. There's term policies with inclusive riders or riders you can add on that would provide a long-term care benefit. And I'm not quite worried as much about that car crash because that's one in a gazillion that it happens to. But the realistic scenario is the health issue. You see, a lot of people just assume that they can buy long-term care whenever they want. But if your 40-year-old is diagnosed with MS before they hit 60, they're not going out and buying long-term care. But had they bought one of those term policies that had the right riders on it, they'd have an option later in life. And these are things we can do for all ages, just to be clear. And so what I think we have to do today is rethink what we thought before, because in the last few years, the future economic outlook is more bleak than it's ever been from my perspective. You may agree. And people who might have said no before might want to say yes or might want to cover one of those other risks. And if we only present the risk of long-term care, I think that's a mistake of how we go about the words risk management, right? Because in retirement, there's a lot of risks we face. Longevity, long-term care, market risk, sequence of returns, cost of liquidity, and more. And maybe the new question we need to be asking clients is, which one of these risks do we want to insure for and take off the table? Maybe it's long-term care, maybe it's longevity and so forth. But this puts a more holistic risk management perspective to things. And I think we'd do better if we have those kind of discussions with clients. And so we can do all the cash flow analysis we want, but we don't know the future taxes. We don't know if or when they'll need it. They don't know how long we'll need it. And those are all what ifs that make the crystal ball cloudy. And again, you might be a projection person. I'll tell you right now, you can outinvest my life insurance products under the right scenarios. But where you project, I can guarantee, and thus that's why I look at everything as safety nets. You can only fall so far if you have your safety net. And the question becomes how high or low, how long should your safety net be? And for clients, again, some are not as concerned about earning an extra point as they are about sleeping well at night. And so, yeah, you might outinvest these, but you might not. But let's take that financial decision and let's look at the client peace of mind and how they live day to day. And often we're only going to know with hindsight whether or not we did the right thing of buying or not buying insurance a long time ago. But which one's more harmful? Having the coverage and not needing it, or needing it and not having it? And again, other risks are involved here too as to future earnings and actual yields on their money and such. So what I do know is that any of these long-term care products add flexibility and they increase the percentage of a positive outcome for somebody is the reality. The long-term care insurance products provide asset protection, asset leverage, dignity, and time to adjust the plan. Now, the asset leverage we'll get to in a few minutes more so, but I want to talk about the dignity part. I'm not a mushy kind of a guy as much. I'm a facts and figures, but I don't want to discount the emotional situation of discussing this concept with people or them discussing it with their clients. But going back to my dad's situation, who had Alzheimer's for 7+ years, and then we finally had to start getting care. And at the end, he was at home shriveling up to die, unfortunately. And that's a very indignant situation. But I'm so grateful for my niece's husband, who's a trained nurse. He came over to bathe my dad. And it was bad enough to see him shrivel up and die in the way that he did, but he saved me from having that in my brain the rest of my life. And I'm going to share another singer-songwriter with you here, Jason Isbell. His song Elephant is about a lady with cancer. But his line is, there's one thing that's real clear to me: no one dies with dignity. We just try to ignore the elephant somehow. So we hope that today inspires you to have better conversations with your clients. Don't allow them to ignore this elephant in the room. Help them have family discussions if they need. And, for those who don't have a lot of assets or a lot to protect, we can all debate the asset level of this situation, but the Medicaid spend down rules say that you can't give away things within 5 years of needing care, or they'll come back in the estate. So having some insurance buys time to adjust the plan and maybe move things around to have a better outcome for your family, as another value of having some insurance in place. And so, as all insurances, hey, if I knew which of your clients were going to need care, we would just go out and insure them, right? But we don't know that. Insurance doesn't work that way. It's all a pooling. Some win, some lose, so to speak. But we help you get back to where you should be, or help you get care in the case of extended care here. And so I can show statistics till I'm blue in the face, but the statistics don't matter when you are one. If you are one of those Alzheimer's situations, and you did or didn't have care, you'll feel good or bad, or I should say, if you did or didn't have insurance, you'll feel good or bad accordingly to it. And the insurance options create tax-free cash and avoid shrinkage. And what I want to mention here, I know that a lot of advisors don't talk about this stuff with their higher net worth clients, but we place long-term care products of all three flavors on high net worth clients on a routine basis. And the reason being is they understand leverage, they understand tax-free, and they understand avoiding shrinkage, having the cash flow that you need without having to invade something at a down price. And so for those reasons, that's why people, even with high net worths, buy long-term care insurance. So I'm going to pause for a second. If you came in late, I need you to log 50 minutes today, so stay through the whole Q&A, please. We'll go the full hour, and I might run a couple minutes over as this is a revised presentation, but we also appreciate you filling in your survey at the end to give us your CFP code, or let us know if you're not one. But if you came in a little bit late, please stay around to log the full 50 minutes, and you might want to stay for the Q&A anyway. But on this board, this is a little grid that I borrowed out of a Lincoln Financial Group presentation. I thought it showed the situation well. And a lot of people call anything that's a combined product a hybrid. And I kind of spell out the difference between a hybrid and Life with Rider. And they are different products. But I'm going to go from right to left here and just say that all things equal, for the same dollar of premium, I'm going to buy more protection with a traditional long-term care product. Next up would be the hybrid. And we'll see this in a few minutes in some examples. From there, life insurance with a rider is the third best way to have bigger benefits, and annuities with riders come in next. And of course, self-funding, there is no leverage. It's all on you. It's all your money. And so let's take a look at the three big categories here. Traditional long-term care is best analogized to your auto or homeowner's insurance, which we know well. You're going to pay, pay, and pay. And unless you have a claim, you're not going to get anything back, generally speaking, with the traditional long-term care plans. Now, in our example, in order to be fair, I needed to spend the same amount of money and look at the benefit pools here to make this comparison work for you. And so in these next examples, we're showing a 60-year-old female designing a 6-year bucket of protection with inflation, and we're spending $10,000 a year for 10 years. So a total outlay of 100 grand over 10 years. And this is a traditional plan that has guaranteed pricing to it. It's the only carrier that I know left in the business, but if we were to buy this, she would start out with a bucket just shy of 400 grand. It'd be over 700,000 when she's age 80 and continue to grow. And if she needed care right away, she'd have 5,500 a month maximum to take from the pile, and 9,900 a month at age 80. Now, if she wanted a hybrid because she wants to get her money back, this too has guaranteed pricing, but hybrids also allow you the ability to quit and get some or all of your money back too if you change your mind. And so in this hybrid, all things equal, she's buying a little less protection, less monthly, less total pool, but second best, as we showed on that little grid, as to how hybrids work. And if she bought life insurance with a rider, I term it as a known outcome. I have $1 million policy with long-term care rider. I know that $1 million is being paid irrespective of me needing care. And whatever isn't used for care is going to be paid out. And what I want you to think about here, imagine within your clients, because we in the advisory business, we get to speak to clients of all ages and different ranges of wealth and incomes and thinking and all that stuff. But life insurance with a rider, in my opinion, is the future of long-term care. And the sooner we understand and accept that, the better off we would be. So when your client's 40 years old and they're buying the bigger house or just got the raise or promotion or whatever, and they're looking to add some more term, maybe you want some permanent with a long-term care rider. So imagine if they're 65 and they have a $500,000 paid up policy to have some protection for care. That's the kind of thinking I'm dealing today because of the estate tax laws. We're dealing with some clients that have overfunded IRAs, if you will. In other words, they're lucky enough to have a big amount in there. They know they won't spend it all, and they also know it's the worst asset to die with because of double taxation. Maybe through the years, some of that money should have been diverted to a life insurance policy with a long-term care rider, and they'd be in a little bit different situation. But in this case, this female 60 for the same 10,000 for 10 years, she can buy a $267,000 policy that's paid up and guaranteed after the 10th year. And if she doesn't need care and dies at age 80, it's the equivalent of a 6% return net. If she dies at 90 and didn't use care, it's the equivalent of a little shy of 4%, but these are net numbers, net of management fees, net of taxation. And the way I look at a lot of permanent policies is they are a bond alternative to a large degree, but much better liquidity and simple with certain types of life insurance. So these are the three flavors of long-term care products. And what we need to figure out, and if you had long-term care insurance and you go on claim, the two big questions that you're going to ask of any of these products is how much are you going to give me and how long are you going to give it to me for? And so I definitely see clients who have analysis paralysis through the situation. So I play the claims game with them, and I go through different scenarios. And the reality is we don't know for sure today which product to buy because we don't know what's going to happen tomorrow. But here's a comparison of the monthly amounts and the total pool of care shown on these examples. And note that the hybrid has $110,000 death benefit on it to make note of. So traditional gives you nothing back if you don't need care. Hybrid is going to guarantee 110s paid out one way or the other. If you use 50,000 for care, then 60,000 will be left of the rest of that death benefit. And of course, life with rider, the death benefit is the pool of care. It just allows a larger access to it earlier on than what the other products do as well. These are some of the pluses and minuses. And so the first question, if I'm diagnosed with Alzheimer's at age 90, which product do I want? Well, it's very clear that I want the traditional. It's the highest monthly and the biggest bucket. But right behind that is the hybrid, if you look at it. And some people, the trend is people are doing hybrids or life with rider more so than traditional because there's fewer carriers in the mix. And, and there's risk if you don't buy a guaranteed premium, of course. And we're dealing with the fallout from that from many people. If I ask the claims game question of if you die at age 80 without needing care, which option do you want, Mrs. Jones? Well, that's an easy one. The traditional returns nothing. The hybrid returns 110. The life with rider gives her 267 back. So she paid for a known outcome, if you will. And if I want guaranteed pricing and payback with the biggest bucket, again, the hybrid under our first question was second best. And so it becomes the best if that's what I want to have. I want some payback for it, so I give up a little bit to get another option, and that's what insurance is all about. The risk and the reward, if you will, and the premium are all corresponded. So some people with traditional long-term care, few of them are buying the 1 or 10 pays that are available at one carrier. More so, they're buying continuous pay, and that's what's in the middle here. And so over time, you could easily spend a lot more even though the premium's almost half for a full pay long-term care. And then what we did in the far right column was just show the potential that, I believe you're going to have price increases. I don't think they're going to be as severe, excuse me, I don't think they're going to be as severe as what we've seen with other carriers out there today, but they will be concerned. And so what we showed here is every 10 years, your premium goes up by 30%. That's where we get to that total of 252 at age 90, and just something to compare and know what's going on. So what we do know is that only hindsight is 2020, right? I don't know if your client, and this is the concern with traditional or even hybrids. I don't know the best option for you to buy. I don't know if you're going to need care, or if so, how long and all that, or what it'll cost. But what I do know with people is the life insurance conversation is different than any other insurance risk because it's not an if, it's a when, right? We all die. That's the only thing we know for sure. And I don't use the death and taxes thing because I've heard of people avoiding taxes. So only death is for sure in life. And that's why I think the life with rider option makes sense for certain people that can afford and are willing to part with that money. And note, you can look at this at age 55 and you can say your client's going to decide to buy it a few years down the road when this happens, when that. Well, it isn't just money, it's good health. And that's why I have a case right now, a fee-only advisor that we spoke with his client, and he kind of started getting into all the options, and he invited me in, and before we went further, I screened their health. And now they're going to be sad to learn later today that we can't write insurance on the husband right now because of some of his health. And so our process is very thought through, and we start with screening health before we talk a lot more. We understand that all three options leverage our dollars into tax-free dollars for what ifs down the road. And for those that don't buy long-term care, I think a next important question is, do you have any legacy goals? Because sometimes I want to make sure we take care of that. So sometimes it's, hey, put the house in an irrevocable trust. So at least you leave that, and that doesn't get eaten up if you're not going to buy insurance or you can't get insurance. And should you remain self-insured is a big question for everybody, right? And that's where you come in to help with your clients. But all clients are not equal. Every client has their own dynamics to them, their wealth level, their family dynamics, their desires, and so forth. But there's some clients that stand out that need long-term care more than it might be apparent. Single people, those who don't have family or have family living close to them. And then we all have our asset level thing. I think the number is 1 to 3 million. In other words, if I look at my prime target market from a wealth level, it's the people between 1 and 3 million that likely need to look at this more, because if they might handle one event, but handling both might be an issue. And so those might be ones, we all have our numbers. You have yours, and again, I emphasize, I've had some very high net worth people buy long-term care, and they understand the value proposition. They're willing and able to spend the money, and that's what they care to do. That's the safety net, so we help provide that. Decide if you're protection or probability thinking. I'm very clear. Insurance consulting is in the name of our business. And I either place safety nets under people or I don't. It's that simple. But can you get your opinions out and take your clients? Maybe they're more protection than your probability. If that's the case, can they win that argument with you? If not, or if so, in either way, you want to document these discussions. We more and more, you are already fiduciaries if you're in the fee only world and with NAPFA and such. And even my world is turning more fiduciary, although I've always considered I'm that. And we need to document these discussions when people say no, or even when they say yes, it all matters. And so let's look at a few creative situations here to consider. Pay yourself for caregiving. We'll look at a couple of shared bucket situations. We'll discuss legacy or care option. And then along the way, I've been asked by a number of advisors that, gee, I wish there was a long-term care product that kind of worked like my umbrella liability, right? I'll take so much risk, but once I'm there, I want you to take it all on. And there's a product that's like that, and I'm going to explain that to you as well. So with caregiving, if you have an indemnity claims product, it pays you cash. And so we know, in my dad's case, my mom was caring for him substantial part of her time. If we had an indemnity product on dad, it could have paid money for paying mom, if you will. Now, I want a sidebar that could be considered taxable income in a job for the spouse, but I also know that certain things don't hit the radar of the IRS. But an indemnity claims allows you to pay your spouse, your children, an unskilled caregiver, whomever you want. You control the care regimen. A lot of people prefer indemnity versus reimbursement claims, and we just want you to know that. And so if you think you might be your spouse's caregiver someday, why not get paid for it, or have this for when you can't care for them? Now, shared care buckets, the problem that we've seen with the premiums that I'm talking about here, a 60-year-old female, $10,000 a year for 10 years, and doing the same thing for the other spouse, that can be a point that they don't tolerate well or can't do. And so this product is a shared care bucket. It's similar, it's a hybrid, just as we looked at. In this case, though, the benefits are lower than what we looked at on the single female because I'm including the spouse. In this case, I have a husband and wife in the mix, and the benefits are lower because the odds of one of them needing it are higher. It's that simple stuff that we price things on. And so if I can't get the 10,000 a piece for both of them, doing this is better than zero from where I come from. Again, your safety net is not as high or long, but you still have a safety net versus crashing all the way. For those that tell me that they've decided not to insure it all, again, this gets into an asset-based level. That 1 to 3 million mark could be part of the range here. But this is a unique product, and I want to mention in this one, I am showing the 20,000 a year for 10 years. Okay, so husband and wife are both insured on this. This is a second to die life insurance policy, and the death benefit is only available to the surviving spouse, or if both spouses need care at the same time. So again, what you're hedging here is saying, I don't think I'm going to buy long-term care. Well, maybe I should buy some. And what if the first spouse needing care is that Alzheimer's thing, and we do a lot of damage to the estate and a pile of money? Now what's going to be left for me? I want to avoid that widowhood penalty. Well, this might be a way to do it. Simply put, this provides the largest leverage or legacy, more than an individual policy would, for the same amount of money, as the long and short of it. And so in this situation, note the increased value of the IRR if you don't use care. So in this case, if they dedicate 200,000 over the next 10 years, this 60-year-old couple creates almost 700,000 in a death benefit. If the second one died at age 90 not needing care, it was equivalent of a 7% net rate of return. And if the surviving spouse does need care, or they just need more income. Having this in place, again, is a permission slip to maybe annuitize a pile of money if I'm starting to eat into the pile and go down. So it just, again, it adds options, flexibility, and a higher potential positive outcome is the reality of it. Now, for the last example here of our high deductible alternative, again, if you don't buy long-term care, then your full pile of assets that you control are in the pile for exposure to paying for care. What if we took $200,000 out of the pile and buy this product? What we do here is simply that we have this, again, is another second to die product here. It's a $289,000 death benefit. So I turn my 200 into 289 at the second death. And if I need care, the first part of care at $8,700 a month is going to be eaten into that 289,000 benefit. That's more than your money of the 200, right? Excuse me, we've leveraged it a little bit, but once you've used that amount of care, we have $8,700 a month. There is no inflation in this design. We have $8,700 a month for the rest of your life. And if both spouses need care, we have $8,700 a month for each one of them. Once they've depleted that first stage one of 289, the death benefit component, they have $8,700 a month apiece for as long as they need it. So this might be something some of your clients want, especially if they're predisposed to having Alzheimer's in the family. Is the reality of it. So another pause here that we're getting close to 50 minutes on the hour, and I just want to emphasize to put some questions in the Q&A box. For those who arrived late, please log 50 minutes, so stay through the Q&A if you need to. And I'm talking fast because there's a lot of material, and you've heard some of this before, unless you're new in the business. But what if you're not healthy enough? Okay, this is some of the things that I offer or want you to be aware of in designing stuff with people. If you decide not to insure for long-term care, whether you're not able to insure because of health or whether you choose not to insure, maybe we want to cover some of those other risks in the pile, right? A QLAC, a qualified longevity annuity contract, is something that I do as a pseudo benefit, right? So think about somebody with a couple $1 million portfolio at age 65. You've got to make that last maybe 30 or longer years as far as a planner. And what if we took a couple 100,000 off of that pile and create this stream of income that's guaranteed to start at age 80 or 85? That just takes some stress off the investment component, right? In another way, and this is where it isn't a great match, but the odds are the older I am, the more likely I'm getting closer to needing care. And if I'm in that situation, and let's say at age 80, I start needing care and I start eating into my pile now, I know that I set this QLAC to happen at age 85. So I've got some reprieve, and that's peace of mind and safety nets and all that stuff. I've used annuities where they double the income. So just making this up here, I put some money in an annuity. At age 80, it guarantees me and my wife $10,000 a month for income. If I just hold on to that annuity, and if I were to go into nursing care, I would turn the rider on then, and now it'll pay me $20,000 a month instead of 10, as long as I have a positive balance in the bucket. That's some other things that we design. There's a deferred annuity that doubles the protection value, needs no insurability at all. You just have to be able to do all 6 activities of daily living today. And then when people are uninsurable, this guy that I mentioned, he's not insurable right now, and I have to deliver that news later today to the advisor. But I'm going to ask, does he have any term life insurance on himself? Because if that's still convertible, maybe we want to convert that. And not that I can draw off of it because it won't have a long-term care rider, but it's now a replenish the bucket for the spouse, right? So she doesn't get into that widowhood penalty that we talked about. And of course, if legacy is important, put things in an irrevocable trust now, gift them to the kids now, whatever you want to do to make sure that you have assets going to them. And sometimes it's a life insurance policy in an ILET to leverage that for them. So the last couple of things I want to talk about the payroll tax. If you're not aware, a couple years ago, the state of Washington put this in place. It went effective last year, and 58 cents for every $100 is going to be taken out of somebody's payroll check to provide a great benefit of 36,000 lifetime. Ooh. And I don't even know what the 10 ADLs are, quite frankly, but you need 3 of 10 instead of the 2 of 6 that most long-term care policies work on today. And so what this means is you as an advisor advising your clients down the road of life, you need to be aware of it, and maybe we want to do things to avoid it. What we see going on, the next 2 states in line appear to be New York and California. And they're doing things a little bit tricky here, where Washington allowed you to have any of the flavors as long as you had a true long-term care rider on it, not a chronic illness rider. It's a little bit different. It has to fall under code 7702, which we can tell you more on. But what New York has going on right now, they're only allowing traditional. That's, there's one carrier that I have access to in the brokerage marketplace. One traditional carrier is available in the state of New York. So even if that carrier won't insure you, you don't have an option to avoid the payroll tax. But they're trickier than that. If they decide to implement this law this October, you had to have your product already by January 1st. So who knows? And as far as client conversations, there's some more states in orange here to be aware of. Keep your eyes open. By all means, feel free to let me know if your state has something special, because it's hard for me to keep track of all the states, but we do work nationally with you as a NAPFA resource partner especially. And so what I think that we learned from all of this is that you should be maybe discussing with your younger high income earners the potential that this payroll tax is going to happen, because they'll suffer from it the most, right, and the longest. And maybe, I believe we should have a long-term care conversation in full and buy whatever they want for their permanent solution. But if they like a hybrid, and if hybrids aren't going to be allowed to exempt you from the payroll tax, maybe we add a small traditional plan as a side thing, cheaper to pay that than to pay the payroll tax, depending on where your income level is. So these are things that are evolving, and we will try to keep you posted, but they're getting creative out there. And again, it is a societal problem, and the Medicaid programs in all the states are going to suffer more as they pay for more and more clients. We have the other half of the population out there who don't have much wealth or saved that, are going to need care, and they don't have anything. So they're going to go on Medicaid. And so I understand the payroll to a degree, but I certainly don't want to pay it. And, unless they invoke it that only traditional in Illinois exempts you, otherwise I'm protected for my situation. So we hope that we are providing some stuff to have better long-term care conversations with your clients. We want you to evaluate whether or not insurance should be discussed, consider which risks in total they should insure, not just, do you want to insure this? Do you want to insure that? We have to look at them all for a smoother retirement, and utilize the resources that we're sharing with you, document their desires and decision, and utilize IIC for screening, design, and implementation for the products that you want your clients to have. And so you don't need to write this down, but I'll just share real quick on our EDU portal. This is the address. There's 2 articles. I believe you can take these 2 articles, taking the first step and exploring the options, and you can have a good conversation with your client. But I have a full video for clients on there, about 40 minutes, about that discusses taking the first step, that goes through some of the stats and things we discussed today. And I have a shorter video on just the insurance flavors, walking through the pros and cons. These are just a glance of these articles. These will be sent to you as part of your kit, along with that portal link and along with this step-by-step claims guide. I have all kinds of stories I could share, but we did run to the 50 minutes here. I do have some questions in the Q&A. And if you came in on time and you want to depart, I want to thank you for joining us today. And look for our fall meetings that we'll be sending out in the next couple of months. And if you want to have a discussion about any client situation or how we work with you, please let me know. If you'd like us to present a CFPCE course that we offer to your study group or your firm, please reach out. We'd be happy to accommodate with that in most situations. And again, thank you. I'm going to get into my Q&A, and let me see here. So what is the shortest period of time for a fully paid up policy? Actually, I can pay up all three flavors in 1 year, and beyond from that. So there are restrictions in all products, and some of the hybrids specifically. This person's question has the years 5, 7, and 10 in it, and there are hybrids that allow 1, 5, 7, and 10. You might be thinking of that specific carrier. And anyway, we can pay them up almost, not every single year is available, but we have a large variety. Are there 20 pay policies to get fully up? Actually, yes. So again, I can have lifetime pay, I can have one pay, and I can design most years in between, to be clear. Somebody that I know is in the state of New York. Unfortunately, that umbrella-like policy is not available in New York. It is, however, available in California, and it is available in Florida. So you know where that's at, and this is the fun of why we need to know where you're working or where your client lives, because New York is the worst insurance state. There's some good things about their laws. They don't let crappy companies in the state. I don't see BS products in that state in the way that I can see it in other states, but they also limit a lot of carriers from sticking their neck out or even wanting to put up with all the extra fun of their insurance regulations. Next question. So how would you guide clients where only one spouse is interested in long-term care, such as the wife whose family has history of dementia and Alzheimer's? I get this a lot. It's often in this, what I showed that shared bucket that we could put both of them on. The reason I showed it is that was a premium limitation I had, right? They didn't have 10,000 for both. And I'm in family situations where I can buy insurance, of a good value and a good level amount for one of the spouses, but they don't have the money for both. Often, especially in your situation with the history on the wife's side, but walk into any nursing home in America, it's 70% women. And so given that thing without even knowing about the dementia, if I have a limited premium dollar, I'm going to usually spend it on the wife. Okay. And if it's two females married, I don't know what to do there, but I'd put it on the one with the dementia in their family if that were the case as well. But that's my answer there for you. And so this one, what do hybrid annuity options look like today, multiples of amount invested? For the person who sent this quote in, an additional resource we will be sharing with you is a price grid. I don't like to answer that question because I don't want to get it wrong, but this is logical and you might already know it. Obviously, the younger you are, the higher the multiple, and the older you are, the less the multiple. And so that's the value of insuring at younger ages while you still have good health. I have a guy who's getting remarried, and we're talking tomorrow, and he's doing a few things. He has some wealth. He's not, inviting her in on half of everything right now, but he wants to set stuff up, and she's younger than him. And I said, hey, you can, in addition to some life insurance for her, or leave her the IRA and leave the life insurance for the kids. In addition to that, you could throw 100 grand into one of these hybrid things. And, if you make it, and married till the day you die, you're leaving her better off because you're protecting that contingency from her, even though she's not getting a whole pile of money. So if there's any other questions, please do land them. I want to thank you again for tuning in with us today. And please reach out if we can be of value. You will get the different pieces I've shown along with that price grid and a replay of today. And I'll just mention that we've started a YouTube channel, and we're putting some stuff. The stuff on my YouTube channel are for you, the advisor. Our EDU portal is stuff more designed more for clients. I don't speak as much insurance jargon. I certainly don't speak as fast because they're hearing things sometimes the first. And anyway, just want to let you know the things we're setting up for you to help you with your client conversations and leveraging your time with education with your clients. So if there's more questions, send them. Otherwise, I'm staying on the full time here. I am going to shut off the recording. And again, thank you for spending time with us today, and enjoy the rest of your day.